Hello everyone, welcome to ACCA P6 video lectures brought to you by AccountancyTube.com. We are at capital gains tax. Just a couple of lectures left. So in the previous video lecture we used both, I delivered one single lecture for both F6 and P6 as I did the lecture before that. So we have seen what would be the capital gains tax when we dispose of shares in our previous video. And we did a couple of questions as well from F6 exam kit. I know that you don't have an F6 exam kit, but them questions were just basic questions, so that's why I share the question through the screen share option as well with you, so that you can look at the questions as well. We will do more advanced questions which are relevant to P6 in our next video. We'll do a couple of questions. We will do one question in this video as well. So that would be a good practice, and then I will give you the list of questions that you have to do, during your own time. All right, so you do not have to worry about that. However, if you come to page number 52 of your P6 lecture notes, let me share the screen with you through the screen share option with you. And question number 52 of your P6 lecture notes: disposal of shares. Now this is exactly the same material which we have covered in our previous video lecture. What you have to do is you have to go through these notes of your own P6 notes. The pages might be different in your the F6 notes and the P6 notes. Of course the pages will be different, but material is exactly the same. So whenever I say that this same material is given to you in the P6 notes, then you will have to read it from your P6 note, because it's just a waste of time to make two separate video lectures of the same material. Now page number 52, it's exactly the same material which I've covered in the previous video lecture when we dispose of the shares: right share, bonus share, reorganization, takeover, then quoted shares gifted, and on the next page how to calculate chargeable gain for the companies. We know that we have to deduct the indexation allowance. Now on this page, at the end of this page, there is a disposal of a substantial shareholding exemption. That is new. That is not part of the F6 syllabus, so we will just have to read this one. So disposal of the substantial shareholding exemption, and that is important as well as far as P6 is concerned. So mark it as important, please. Not as complicated as it is important. So it is so important but less complicated. So disposal of substantial shareholding for the companies. Now the gain on sale of shares by a company is exempt. Whenever one company sells its shares, gain made on that would be exempt. If certain conditions are fulfilled. What are the conditions? Now the company which is selling the shares must be a trading company. The shares which are being sold, that company is also a trading company. So the buying company and the selling company, both are the trading companies, and selling company must hold 10% shareholding in that company, in the buying company, in the company in which he had the shares, right? So if company A holds 10% shareholding in company B, and company A is selling its shares, then the gain gain made on that, there would be there would be exemption on that, because it is a disposal of substantial shareholding. All right, now you have, the company must have owned this share for 12 consecutive months. The company must have owned these shares for 12 consecutive months in the previous 12 years, in the previous 2 years. So that is another condition as well. So let's read from the notes then. The gain on sale of shares by a company is exempt if the company has substantial shareholding. Substantial shareholding is when a trading company holds 10% or more shareholding in another trading company. The exemption applies to disposal of a part of the substantial shareholding if at least 10% holding test has been met for continuous 12 months period. 12 months in the previous 2 years before the date of disposal. So this is the 2-year period. In the last 2 years period, you must have owned this 10% for 12 months. All right, so half of 2 years is 1 year. Right, so the disposing company and the purchasing company, both companies must be a trading company, and the shares must have been held for 12 months in the previous 24 months, and the shareholding must be 10% or more. Right, so that is our substantial shareholding exemption. Right then, on the next page, if you move page number 54, principal private residence, we have seen that as well in the previous video lecture. You you will have to revise it, and please make sure you read this one as well. Now, a couple of more things which were not part of our F6 syllabus. If you see principal private residence part, the note B, any period of absence to live abroad, that is, we have already seen that. Up to 4 years of absence to live elsewhere due to his work, that we have seen. Now, garden lawn of up to half a hectare attached to the house is also exempt under PPR relief. All right, so that is new information. Now, where a person has more than one residence, if I have this residence, one in London and another in Liverpool, then in that case I will have to elect any one of that as my main residence. He may elect for anyone to be treated as his main residence. Now, where married couple live together, and then only one resident may qualify for residence for relief. All right, so if we have married couple and then we have two properties, then we will have to elect only one of that to qualify under PPR. If part of the residence is always used exclusively for business purposes, we know that that will not be for PPR will not be available on that portion. Right then, after that, the letting relief, we have seen that as well in our previous video lecture. And then it's overseas aspects of capital gains tax. Right now, this is this overseas aspect of capital gains tax that is new as well for P6 students. Right, so what are the overseas aspects for capital gains tax? Now, normally what happens, we have seen the residence and the capital gains tax in our chapter of residence. So someone who is resident and domicile, and then domicile and resident. So that is basically exactly the same concept here as well, but little more addition of temporary non-resident. All right, so someone who leaves the UK for some period of time and with the intention of coming back to the UK, excuse me, that person will be temporarily non-resident. So let's read from the notes then. If a person is resident and domiciled in a tax year, then he is liable to the UK capital gains tax on disposal of the assets situated anywhere in the world on a rising basis, only if he is resident and domiciled. Then it says that if a person is resident but not domiciled, so a person living in the UK but not domiciled, like myself, in a tax year, then he is liable to UK CGT on disposal of overseas assets unless I claim remittance basis. And I know when I claim the remittance basis, I will not get the annual exempt amount, and I might have to pay remittance basis charge as well. Right? Then after that, it says the disposal for disposal of asset to be temporary non-resident, the asset disposed during the tax year. For disposal of assets by the temporary non-resident, someone who is temporarily non-resident, the asset disposed in the year in the tax year of departure are taxed in the same tax year. Any subsequent disposals are taxed in the tax year of return. So if I am temporarily non-resident, if I am living in the UK but I am leaving the UK now with the intention of coming back to the UK, and now the assets which I am selling now will be taxed in the tax year of departure. Now, when I left the UK, the assets which I have sold after leaving the UK, them assets will be taxed in the year of return whenever I come back to the UK. All right. Now, excuse me. Now, when I am away from the UK, I might be buying some assets when I'm away from the UK. So I'm living in India, then I'm buying the assets in the UK, and then I'm selling as well. So I'm sitting outside the UK, I'm buying and selling the same assets. So if I buy an asset in the period of absence and I sell the asset in the period of absence as well, that specific asset will not be taxable. All right. Now, assets which I have bought when I was living in the UK, when I was resident in the UK, assets I bought then will be subject to capital gains tax either in the year of departure or in the year of arrival. All right. So, excuse me. Now, after that, it says a temporary non-resident for CGT purposes is someone who is living, who is outside the UK for less than 5 years from the year of departure and the return. They were UK resident for the 4 out of the previous 7 years immediately before the year of departure. So that is the criteria for basically temporary non-resident, and it is very, very common for examiner to ask this in the exam. Now after that it says any assets bought and sold during the period of non-resident is exempt, as I explained to you earlier. When I am not in the UK, I'm buying and selling the asset, it will be exempt for capital gains tax purposes. Right then, let's look at a past exam paper relevant to this overseas aspects of capital gains tax. Overseas aspects of capital gains tax. If you could come to page question number 11 of your BPP exam kit. Question 11 of BPP exam kit. Question name is Brad. It was examined in June 2013. Page number 16 of BPP exam kit, current version. Please remember, by the latest exam kit, it's useless to do the question on the old exam kit, which involves the old tax rates, old rules and all that stuff. It's not too expensive to buy the exam kit when you're paying for exam over 100 quid. Right? So please do not use the old exam kit and not use the questions from the ACCA's website because they're not updated. Right? So if you can come to question number 11, if you have any other exam kit other than BPP like Kaplan, please find the question Brad in that exam kit if you have. Otherwise, as I explained you, that please buy the BPP exam kit as I'm using this one, so it will be easier for both of us. So question number 11, Brad, examined in June 2013. In the requirement section it says carry out the work required as requested in the email from your manager. It is a 25 mark question. We'll only be doing the capital gains tax. So first of all, it says capital gains tax, 8 marks, and inheritance tax we won't be doing that one for now. So just above that, it's email from your manager. So it's the email from your manager where it says that capital gains tax. An explanation with supporting calculation of UK capital gains tax liability. So what we have to prepare basically. So that's what we have to prepare. So we have to prepare an explanation with supporting calculation of the UK capital gains tax liability in respect of the disposals made by Brad while living in the country of Kyrenia. So basically he's living in the country of Kyrenia and he's making some disposals while sitting in Kyrenia. So your explanation should include the precise reasons for Brad being regarded as only temporarily non-resident and a statement of when the tax will be payable. Right, so when the question starts, there's a heading of capital gains, so we'll have to read that one. And before reading that one, just read the personal details paragraph as well, which will give us the background of the information. So when he's leaving the UK and what are his intentions. Brad is 69 years old. He's married to Laura and they have a daughter, Danny, who is 38 years old. Brad had lived in the UK for whole of his life until he moved with his wife to the country of Kyrenia on 1st of January 2015. Right? First of which month, I don't know. Anyway, man, this information is missing in my exam kit, so you just have to check. It's 1st of I don't know which month, but it's 1st of whatever 2015. Excuse me. Then he says that he returned to live permanently in the UK on 30th of April 2018. So he left the UK in 2015. Then he will come. He came back to live in the UK permanently on 30th of April 2018. Therefore, he was non-UK resident for the tax year 15-16 to 17-18 inclusive, but otherwise UK resident. So basically he was temporarily non-resident because he was outside the UK for less than 5 years, and he was UK resident for 7 out of the previous 7 years, so that condition is also fulfilled. So he will be temporarily non-UK resident for capital gains tax purposes. The split year treatment did not apply in either the 2000 previous year and the 2018-19. He has always been domiciled in the UK. And then it says Brad had significant investment income and has been, and this information is missing as well, has been higher rate taxpayer, is it? I think it's high rate, and has been high rate taxpayer for many years. Right, so he has been a high rate taxpayer. Excuse me. After that it says capital gains. So whilst living in the country of K, Brad sold various assets asset out below. So he sold these assets. He has not made any other disposal since 5th of April 2014. So asset details is given the date of sales, proceeds, date of purchase and cost. First of all, we have to determine that if he is temporarily non-resident or not. We will write in our answer that Brad is temporarily non-resident for capital gains tax purposes because he left the UK for less than 5 years. He left in 2015 and he came back in 2018, which is less than 5 years. And he has been UK resident for the whole of his life before, which means he has been resident for 7 out of the last 9 years. So he fulfills the criteria of temporarily non-resident for capital gains tax purposes. Hence, his capital gains tax, the assets which he purchased and sold in the year of his absence in the UK will not be subject to UK capital gains tax. It will be exempt. Assets which he purchased and sold while he was absent, so them assets will be exempt. However, the assets which he sold in the year of departure will be taxed in the year of departure. Assets which he sold in the year of return or in the year when he was not in the UK, them assets will be taxable in the year of return. Alright, so these are the following assets. We will have to calculate the capital gains tax on that as well, and we have to determine when that would be payable. Now, first of all, quoted shares, date of sale was 1st of February 2015, so it is just before he left the UK, and it is 18,900 is sales proceeds, and then date of purchase is 1st of October 2013, so he purchased when he was a UK resident. So take the sales proceeds of 18,900, deduct the 14,000 cost out of that. Remaining amount is our gain, which will be covered, I assume, by the annual exemption. Right? Now it will be chargeable in the year of departure. Then after that it says painting. Now painting date of sales is 1st of June 2017 when he was not present in the UK. He sold for 36,600 and the date of purchase is 1st of May 2013. So this will be taxable in the year of return because it was sold just before when he came back to the UK. So 36,600 is the sales proceeds, 15,000 is the cost. Remaining amount is our gain. We'll deduct the annual exempt amount out of that, and if there is anything left, then that would be taxable at the rate of 20% because he's higher rate taxpayer. Right, and after that it says antique bed. It was the date of sales is 1st of March 2018. When he was not in the UK, and he purchased in 1st of May 2015. So date of purchase is also when he was absent from the UK. So the date of purchase and date of sales is when he was not in the UK. So this will not be taxable. Then after that it says motor car. It was sold in 1st of April 2018 when he was in the UK, and it was purchased in 1st of April 2014. However, if you remember, we have studied the list of exempt assets for capital gains tax purposes, and motor car was one of them. So motor car is exempt for the capital gains tax purposes. Doesn't matter that when he purchased or sold, it will be exempt. And after that it says, I explained that although Brad was a non-UK resident for several tax years, these disposals may still be subject to capital gains tax, but he will be regarded as temporarily non-UK resident. There is no capital gains tax in the country of Croatia. So that was the answer which I've just told you. We will have to write down the temporarily non-resident for him. Then we have to explain that how much the capital gains tax will be payable on all of these assets. Now the asset on which we have to pay the capital gains tax in the year of return, that will be payable, his year of return is which one? His year of return is 30th of April 2018, which is tax 1819. Now tax will be payable on 31st of January after the end of tax year of that. Alright? So we'll have to write down the date of payment as well. That's why I've told you. Right, so that's the end of this video lecture. I will see you in the next video lecture. Now the next video lecture is exactly the same for F6 and P6 as well. So in the next video lecture we will be looking at the different reliefs which are available. Like we have already seen the entrepreneur's relief, but there are some other reliefs as well, like the rollover relief, the gift relief, and the handover relief. Now the earlier relief which we have seen, the entrepreneur relief, on that we will have to pay tax at the reduced rate. Now the reliefs which we are going to see in the next video, most of them are the deferral reliefs, which means we will not have to pay tax at the reduced rate, but we will not have to pay tax now. We will have to pay tax in the future. We may have to pay tax in the future. but the tax rates will be exactly the same. All right, so that are them are the deferral reliefs, which means you are deferring the tax liability in the future. You will not have to pay now, but you might have to pay in the future. I will see you in the next video. Then I will, we will see the different reliefs of capital gains tax. Goodbye.